Hey guys, the companies that lost money in 2021 shocked everyone, including the world's best investors. We'll be looking at the top 10 companies in this video. Number 10. On the list is Airbnb. Airbnb was founded in 2008 and quickly raised $4.4 billion in funding, according to Crunchbase. When it reached unicorn status with a valuation of $1 billion, Airbnb finally went public. Its IPO price was set at $68 per share on December 9, 2020, then soared 112% in just 24 hours when it opened at $146 on its first day of trading the following morning, according to CNBC. Today it trades at around $160 per share. Airbnb has never been profitable, according to Motley Fool, but the company's many bulls insist that because, like so many top stocks that don't turn a profit, it reinvests what it earns to keep growing and growing. The company suffered a crushing $4.6 billion in net losses in 2020. But just as the coronavirus smashed Airbnb when it put the kibosh on global travel, the post-COVID economy will likely showcase Airbnb as an in-demand winner. Number 9 on the list is Blue Apron. Everyone can be an at-home chef thanks to Blue Apron, the grocery, delivery, and recipe service established in 2012. The company went public in 2017 with a valuation of $1.9 billion, but it was an up-and-up ride until the pandemic sent demand for in-home cooking subscriptions soaring. A COVID-19 inspired mega bump in subscriptions allowed Blue Apron to briefly introduce itself to profitability, according to the Wall Street Journal. But the greeting was brief. Blue Apron always had high marketing costs, always struggled to attract new customers, and always had trouble retaining the customers it already had. In addition, Blue Apron had to deal with an increasingly competitive market space, and more meal delivery services sprang up in the late 2010s. HelloFresh and Sunbasket are hot on Blue Apron's tail. According to Coresight Research, meal kit companies enjoyed growth of 70% in 2020, but that rate is expected to plummet when restaurants return to peak capacity. If Blue Apron couldn't cling to the fleeting profit during the best of times, the future is uncertain. Number 8 on the list is Casper. Direct-to-consumer mattress brand Casper was established in 2013 and quickly attracted big-name investors like Leonardo DiCaprio, Ashton Kutcher, and 50 Cent. The company went public on February 5, 2020, with a valuation of $476 million, according to Crunchbase. Casper stated in its filing that it wouldn't be profitable anytime soon, Forbes reported. But a few months later, in August, the Wall Street Journal reported that Casper had announced that it expected to turn a profit in the mid of 2021. Mid-2021 came and went, and Casper failed to keep its promise. On August 10th, shareholders punished the stock with a bruising sell-off of more than 14% when the company announced it would now not turn a profit until 2022. Like so many other businesses in so many other segments of the economy, Casper had fallen victim to supply chain woes, labor inflation, and the rising cost of raw materials, according to Seeking Alpha. Number 7 on the list is Dropbox. File sharing, collaboration, and storage platform Dropbox was founded in 2007 and went public in March 2018. Its valuation at the time of its IPO was $9.2 billion, Crunchbase reported. In 2021, the company briefly made profitable for the first time since going public thanks to a boost from offices and schools going remote during the pandemic, but it wouldn't last. Despite a profitable quarter, Dropbox lost money on the year, with Simply Wall Street reporting that Dropbox lost $256 million in fiscal 2020. But the spell might soon be broken. The publication is just one of many whose analysts are now predicting that Dropbox will break even in a few months and turn a profit within a year. Number 6 on the list is Lyft. Ride-sharing app Lyft was founded in 2012 and became a publicly traded company in March 2019. With a valuation of $24 billion and its IPO stocks opened at $72 a share, the stock value has dropped significantly since then, with the current value hovering around $49. The last time Lyft's operations generated positive cash flow was the third quarter of 2019, according to TechCrunch. But when using the EBITDA format, a stricter way of calculating profitability that's preferred by tech startups, Lyft was in the black the last 3 quarters in a row. And anyway, the company is sitting on a $2 billion in growth-supporting cash. Number 5 on the list is Peloton. Peloton went public in 2019, 7 years after its founding. It was valued at $8.1 billion at the time of its IPO. Although Peloton's CEO John Foley repeatedly stated that his fitness company was profitable, the numbers revealed in its IPO filing tell a different story, and it remained that way until the pandemic. When gyms across the country closed, Peloton became an early and obvious winner in the pandemic. In September 2020, the Wall Street Journal reported that the company had just posted its first ever quarterly profit, but management wouldn't make a habit of it. Just 1 month later in November, according to Seeking Alpha, the company announced it was continuing its march towards 100% plus growth in 2021, which could only come at the expense of profits. Number 4 on the list is Pinterest. Pinterest went public in April 2019, a decade after the digital pinboard company was first founded. Its valuation at the time of its IPO was $12.7 billion, according to Crunchbase. Despite its popularity with more than 450 million users around the world, down from nearly 480 million in Q1, according to Statista, the company is still not profitable. Pinterest fell from its high of around $90 per share earlier this year to its current 56-ish, but it might soon actually turn a profit. In June, Yahoo reported that the company was essentially operating at break-even. Its analysts speculated that Pinterest was nearing the point where Facebook was when it first began amassing profits, and that Pinterest would likely start doing the same thing soon itself. Number 3 on the list is Snaps. When Snaps Inc. went public in 2017, it was valued at $24 billion, the biggest initial public offering in years. The Financial Times reported, however, years later, the company is still not profitable. In April 2019, a Financial Times analysis calculated that the company would run out of funds in 3 years if that didn't change. Like so many other companies on this list, Snap had long prioritized growth over profitability, according to Crunchbase. Today, it's experiencing strong revenue growth that is impressing both investors and Wall Street alike. According to Investors Business Daily, that, however, is no guarantee. At the end of 2020, Nasdaq reported that Snap still wasn't profitable 3 years after its IPO and was still 3 years away from breaking even. Number 2 on the list is Uber. Uber revolutionized the way people get around. The ride-sharing app was launched in 2009 and valued at $8.1 billion when it went public in 2019. But when Uber filed its IPO, it said that it might never make a profit, despite the fact that it had 91 million users by then, Reuters reported. Uber's operating costs amounted to over $3 billion in losses in 2018. It lost $8.5 billion in 2019, according to The Verge. In 2020, Uber's revenues dropped to $11.1 billion from $13 billion the year before, according to TechCrunch. In early August, MarketWatch reported on a phenomenon where both Uber and Lyft were creatively using EBITDA and other alternative metrics to try to convince investors that they had the potential to be profitable. But the industry's contractor-driver framework, ongoing regulatory hurdles, and legal battles and the exploding cost of COVID-era driver retention incentives made profitability nearly impossible, the publication argued. Number 1 on the list is WeWork. WeWork co-founder Adam Neumann set out to change the way people work by establishing collaborative co-working spaces catering to younger workers. He also had plans to expand the brand to residential and educational spaces too. Then the company's failed IPO filing in August 2019 threw a wrench in the gears, but the worst was yet to come. By July 2019, WeWork was losing $219,000 every hour, the Financial Times reported. The company's disastrous attempt to go public resulted in a management shakeup, and then the pandemic came. The virus closed offices around the world, suffocating the company's shared workspace business model. WeWork lost 30% of its customers, according to The Guardian, as revenues were cut in half and losses topped $2.1 billion. Even so, at the start of 2021, the company's CEO announced that WeWork was on track to be profitable by the end of the year. Thanks for watching. Like our video, subscribe to LuxuryMojo, and hit the bells for notifications for our new videos.